In this video, we will be taking a closer look at A.O. Smith's dividend safety. Let's first start by talking about A.O. Smith's business model. A.O. Smith is a leading residential and commercial water heating equipment manufacturer. The company was founded in 1874, and since then the company has grown relatively consistently. Today, A.O. Smith has 16,000 employees, trades with a market capitalization of $8.7 billion, and generates annual revenues of more than $3 billion. A.O. Smith is a well-known dividend stock because of its compelling track record of dividend growth. With 26 years of consecutive dividend increases, the company is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with 25-plus years of consecutive dividend increases. Looking ahead, investors interested in owning shares of A.O. Smith are likely concerned with the safety of the company's current dividend. In this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's consider A.O. Smith's dividend safety relative to the company's current earnings. A.O. Smith announced its fourth quarter and full-year earnings results on January 29. The company reported that it had generated earnings per share of $2.61 billion during the most recent 4 quarters. A.O. Smith pays out 88 cents in dividends a year, which means that A.O. Smith's current dividend payout ratio is 33.7%. Overall, A.O. Smith's dividend looks very safe relative to the net profits that the company generates today. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare A.O. Smith's current dividend payment to its free cash flow. During fiscal 2018, A.O. Smith generated operating cash flows of $449 million, with capital expenditures totaling $85 million during fiscal 2018. A.O. Smith generated free cash flows of $364 million during the 12-month reporting period. The company distributed $130 million of common share dividends during the same time period, for a free cash flow dividend payout ratio of 35.7%. Using free cash flow, our conclusion is the same as when we used earnings to measure A.O. Smith's dividend safety. The company's dividend appears quite safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze A.O. Smith's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. A.O. Smith's performance during this time period is shown here. A.O. Smith's earnings per share declined by 25% between 2009 and 2010. Apart from that, the company's earnings per share rose each year. More importantly, the company's earnings continued to cover its dividend, and it continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess A.O. Smith's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, A.O. Smith generated $8.4 million of interest expense. The company had $221 million of debt outstanding at the end of the reporting period for a weighted average interest rate of 3.8%. The following image shows how changes to A.O. Smith's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, A.O. Smith's weighted average interest rate would need to rise well above the 30% level before its dividend would no longer be covered by free cash flows. Accordingly, we believe that A.O. Smith's debt level is very unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on A.O. Smith's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Video's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.